What's going on, everyone? Welcome back to a brand new video, and in today's video I'm going to be showing you a diversified stock portfolio I would have if I had £20,000 to invest, and this stock portfolio would give you a return of around 19.27% based off historic returns. Obviously historic returns aren't an indication of the future, so don't expect to make this going forward, but it's just a good indication to go off. The reason I've chosen £20,000 as the budget is because this is the max amount you can invest into your ISA per tax year. And if you don't know already, a stocks and shares ISA is a tax efficient way to invest as a UK resident, as all the money you make within your ISA is completely tax free. So jumping straight into things, the first company I have is Google, and I would allocate around 30% of the portfolio to this, which is around £6,000. The reason Google is my number one pick, as they're currently trading at a forward PE ratio of 22. They're a monopolistic search engine, they own YouTube, and they're also growing at 35% in their cloud business. Next up I have Amazon, who are known for their AWS service. They are the number one leaders within the e-commerce space. Currently they're investing a lot of money into capital expenditure, which means they're investing into things that should hopefully yield a return in the future. So if you look at them from a PE ratio perspective, they do seem overvalued, but I think a lot of the capex spending will yield returns for investors going forward. The third company is MasterCard. Now, I made a video recently talking about why I believe MasterCard is the perfect company. They have gross margins of 100%, net profit margins of around 40 to 50%. On their top line revenue, they're growing at around 15% per year. And with the world transferring to a cashless society, I think MasterCard will greatly benefit from this. The fourth stock, and again another 10% allocation to this portfolio, is Uber. Uber is a very misunderstood stock at the moment, trading at an extremely low PE ratio while also growing extremely fast, and they have explosive free cash flow. With free cash flow, they can either use it to give money back to investors via dividends or share buybacks, or to invest into things such as capex. I know a lot of people are saying that Waymo and Tesla are going to kill Uber, but I actually think the opposite. I think they're going to work together to sort of collaborate and use the network effect that Uber does have. And now moving into the smaller positions in this portfolio, the first one we have is Games Workshop. Now this is a UK based company from Nottingham. They create these mini plastic figurines known as a game called Warhammer. Now what people don't realise is they have a huge profit margin, even higher than companies like Google, Amazon and Apple, and they also pay a dividend of 3%. Moving on to the second page now, we have TransDigm. TransDigm produces all the parts for aeroplanes, and they have a monopoly over the whole industry. They're known to acquire smaller companies and put them under the TransDigm group, so they don't have many competitors in this industry as they basically buy them out. They work on commercial aeroplanes and also on defence contracts for the US military. Now the next two stocks, ASML and Novo Nordisk, are two companies that I said are undervalued at the start of the year. ASML designs and creates the machines that people like Nvidia use to create their chips. These machines usually cost around $500 million, and they are the only company in the world doing this, so they have a huge economic moat. Next up is one of the more riskier investments in this portfolio, and that is Novo Nordisk. Historically, the stock has performed very well, and in terms of the medical/pharmaceutical companies you can invest into, Novo Nordisk are probably one of the most ethical. They produce a lot of weight loss drugs and also drugs for diabetes. Again, they're an extremely high net profit margin company. On paper, this company looks extremely undervalued, but the only risk associated with this one is Eli Lilly, its competitor, is growing faster than it. And with Trump wanting to implement tariffs, I think this could negatively affect Novo Nordisk. And then the final three stocks are American Express, Main Street Capital and McDonald's. Now these three stocks are the ones that I'd call the dividend or the cash flow stocks of this portfolio. McDonald's paying just over 82% dividend, American Express just under 1%, and Main Street Capital over 5%. American Express obviously is a credit card supplier. They take on more risk than companies such as Visa and MasterCard, as they actually have the debt of the customers, but I think they have a very high quality core customer base and seem to be becoming a lot more efficient as a company. Main Street Capital gives money to small and mid-sized companies, and in return they will either pay Main Street Capital interest or they give Main Street some of their equity within the company. Then these companies then generate cash flow to Main Street Capital, and then Main Street Capital pay this out via a dividend. And then obviously the final stock is McDonald's, one that everyone knows. What a lot of people probably don't know though is McDonald's is actually a real estate company. People basically buy the McDonald's franchises, they set up it themselves, and they just use all the McDonald's branding and products. And then they will pay money to McDonald's every single month for using these services and using the McDonald's name. Let me know in the comments what you think of this stock portfolio and how you would invest £20,000. If you did find this video helpful, then please follow my page. I'm trying to hit 5,000 followers. Thanks for watching, and I'll see you in the next one.